All right. So let's continue with our revision class. So yesterday, we were able to revise some topics just to remind you of the salient topics that we have covered and the key issues around them. We looked at IFRS 2 on share-based payments. We did a very sharp recap of them. We looked at IAS 19 on employee benefits. We looked at financial instruments, where basically we focused on impairment of financial assets. Just reminded you of the expected credit loss model. We looked at IFRS 13 on fair value measurements, where we looked at the definition, the fair value hierarchy, the valuation approaches, and also the assumptions that are made by market participants, like principal market, most advantageous market, and also that fair value is determined, and also that fair value of a non-financial asset is determined using its highest and best use. I mean, that is worthy of note, because when it comes to non-financial assets and you want to determine their fair value, we usually focus on the highest and best use of that asset, which is the use that is financially feasible, physically possible, and legally permissible for the asset. And we looked at one short question around that to demonstrate how it works out. And we'll look at some other questions on IFRS 13 as well. Now, let's see where we can get to again on just reviewing what we have done so far. Another key part of your syllabus is IAS 36 on impairment of assets. This one is different from that of IFRS 9 that deals with impairment of financial assets. This one focuses on non-current assets, basically PP or intangible assets. So the focus of this is how do you impair those class of assets like PP and intangible assets. And I also mentioned that impairment is different from revaluation deficits. And this is because impairment is a permanent loss in the value of an asset. It's a permanent loss. So, which is quite different from evaluation deficits. That's just a temporary movement or a temporary loss in the value of an asset. So IAS 36 typically wants to ensure that an asset is not carried at more than its realistic value. You should never carry an asset at more than its realistic value, because when you do that, you are going to prescribe the asset as impaired whenever the carrying amount of an asset, whenever it is higher than its realistic value. We will say the asset is impaired. So we looked at some definitions like impairment loss, which is the amount by which the carrying amount of an asset is higher than its recoverable amount. We looked at carrying amount, which is the cost or fair value of an asset minus accumulated depreciation and accumulated impairment losses. Then recoverable amount, which is the higher between net realizable value and value in use. and net realizable value, which is fair value minus cost to sell, and value in use, which is the present value of future cash flows that can be generated from an asset, including the proceeds you get from the eventual disposal of that asset. These are the key terminologies in IAS 36. So when it comes to impairment loss, you need to know carrying amount, recoverable amount. And recoverable amount is the higher between net realizable value and value in use. Now, what do you of note is the indicators of impairment, or what we call impairment review. You need to revisit these external and internal indicators, because before you carry out impairment of an asset, these are the indicators you watch out for first. This is what triggers you for impairment. So the indicators are key. It is after you have identified these indicators, like we look at the internal indicators. This is talking about where there is a physical damage of an asset, or where there is a decline in the useful life of an asset, or when there is a decline in the productive performance of an asset. So when you identify all of that, then you can then go ahead and carry out an impairment test, which is where you're going to determine whether there's an impairment loss. And it is at this level you will compare the carrying amount with the recoverable amount. And I gave you some examples. If the carrying amount is 50 million, net realizable value 45 million, value in use 48 million. So the higher between these two is 48 million, which is the recoverable amount, and the carrying amount is 50 million. So this shows that this asset has been impaired because the recoverable amount is lower. So this asset, you are carrying it higher than its realistic value. So you need to impair it. And for you to do that, that 2 million, you just take it to P&L and you credit asset account. And of course, you know that if the asset is measured using evaluation model, the impairment loss, you are going to treat it in a similar way to evaluation deficit, in the sense that instead of this impairment loss to go to P&L, it will go and net off any previous evaluation surplus, if any. It will have to net off any previous evaluation surplus, if any. And that is where you are valuing the assets using evaluation model. And we solved some other questions that give us details around carrying amounts, recoverable amounts, and all that. And this typically showed you how to determine value in use, where they give you future cash flows that you would have to use discounting factor to get their present value. When you accumulate all the present values, it gives you the value in use. So we're also able to determine the net realizable value. So the higher of these two gives us the recoverable amount. And being that the carrying amount is 150,000 and is higher than this recoverable amount of 132,000, so we have an impairment loss of this amount. And with this impairment loss, you debit P&L, you credit the assets with the impairment loss. Now, we solved some other questions just to demonstrate. So this one also is quite straightforward. You can look at it. Another major one on impairment that we looked at is cash generating units, which is where you have to group assets together in order to get their recoverable amount. And this is applicable where assets does not generate cash flows individually, where assets like air condition, furniture and fittings, and where they need to be impaired, where they need to be tested for impairment, but you cannot determine their recoverable amount. So that is where cash generating becomes relevant, or you need to determine the impairment test of a business or of a business unit. That's where cash generating units would actually be relevant. And IS-36 says that CGU is the smallest identifiable group of assets that can generate cash flows largely independent of other assets. So what CGU usually helps us to do is that by the time you group these assets together, you would be able to get their value in use, which ultimately would help us determine their recoverable amounts. And when we get that, we can then test them for impairment. To get their carrying amount is not a problem because that's their book value. It's determining the recoverable amounts that was the challenge. But now that we have grouped them together, now we can ascertain their recoverable amounts by being able to determine how much they make. How much they make. When you look at them together, you can determine how much they make together. So we looked at a very simple question where they gave us a CGU, they gave us their book value, and they said that the recoverable amount of them together, all these assets, their recoverable amount together is 25 million. And the reason why they are giving us their recoverable amount together as one unit is because we cannot determine their recoverable amount separately. We cannot determine their recoverable amount separately, which is why they gave us together. But the issue is that, I mean, the key highlight is that they have given us, and we can easily determine our impairment loss for the entire unit, for all these assets put together. Because now we know that their carrying amount is 33 million and their recoverable amount is 25 million. So the impairment loss, therefore, is 8 million. Right? So now, having determined this impairment loss, we will need to then know how to recognize it in our books. Yes, fine. This impairment loss goes to P&L, but we will need to also bring down the value of these individual assets. How do you then share this 8 million amongst them? So IS-36 gave us the order of sharing. It says that when you have impairment loss on the CGU, this is how you share it among the CGU. First to a physically damaged asset, next to goodwill, and next to other assets on a pro rata basis. In this scenario, we did not have any physically damaged assets, but we have goodwill. So we allocated 5 million. And the reason we allocated 5 million to goodwill is because the total value of the goodwill is 5 million. So we would need to impair the goodwill fully first. I mean, to the extent that we have enough impairment loss amount, which we do. So we give 5 million to this goodwill, it becomes 0. Then after goodwill, we're going to share the other one on the pro rata basis. and the other assets are building, plant, and current assets. You should always ignore current assets. Don't allocate impairment loss to current assets unless the examiner specifically tells you that the current asset has been impaired also. Otherwise, you'd assume that it wasn't impaired. You assume that, especially when you're dealing with CGU like this. So the remaining 3 million, we shared it to building and plant using their relative values, their carrying amount. And that was why building has had 15/18, which is 15 divided by the addition of these two, multiplied the remaining impairment loss. The same thing for equipment, this 3 million divided by the addition of these two, multiplied by 3 million. So we're able to get this impairment loss amount. And so ultimately, the 8 million has been shared to each of these assets based on the order prescribed in IAS 36. And we looked at another major question. And this particular question is looked at also a CGU, but this CGU is a train station. So they gave us the assets of those CGU and the total assets of the CGU. And they told us that they gave us goodwill, they gave us license, they gave us train station, they gave us rail tracks, they gave us train engine. And we're told that the license has 10 years life. And it is stated at its cost. The property, rail tracks, and coaches, they are based on value in use. And the engines are valued at their net selling prices. The engine are valued at their net selling prices. So with that in mind, yeah, sorry. Yeah, so I was talking about this company. Yeah, so they gave us a CGU, a train station, and they gave us the assets. And this other paragraph is giving us description of each of these assets, that this operating license is at cost, this train station, where is it? The property, road tracks, and coaches, that they are value in use. The engine is at their net selling prices. Okay. They now said on February 1st, 2019, they said one of the train engines got damaged due to a technical fault from the manufacturer, and the engine was completely destroyed. And the sale of the asset to SRL was without recourse to the Transport Ministry and the manufacturer of the engine. So one of the train engine got damaged. That's the issue here. So we're now told that in view of this, it was estimated that there will be reduced passenger capacity. So the value in use of the old train engine was assessed to be 1.5 billion. That clearly, you see, the value of the train engine before was 2.2, but now it is now 1.5. The difference is impairment loss. Again, they also mentioned that the number of passengers after one of the train engine got damaged was below expectation, even allowing for reduced capacity. In the light of this, the value in use of XRL rail services was reassessed again in March to 1,350. Again, from 1.5, it is now reassessed to 1,350. Then I said on this date, SRL received an offer of 675 from another company called Papaya for the operating license. So that means somebody came and says that he wants to buy the license. So that means as of March, the net realizable value of the license is now 675. We're now asked to draft a memo addressed to the MD of Starloss, explaining the basis of allocating an impairment loss to the asset of a CGU in accordance with IS 36 on impairment of assets. So this, I gave you the solution here. So they said you should draft a memo. So you have to give them a memo. And I already told you the order in which you allocate impairment loss to CGU, first to a physically damaged asset, then to goodwill, then to other assets on a pro rata basis. But I made a note here that if there are current assets within the CGU, that this should be ignored unless it is specifically stated that the item of that gave rise to the impairment loss. You should always ignore it. So, so then if they require further clarification, they should revert to us. Then that was it for that. We are also told that we should calculate the carrying amount of the asset of SRL as of February and as of March. So how do you determine the carrying amount as of February? Knowing fully well that as at the date we bought these assets, which is in January, these were their values. These were their values. And as of February, they have reassessed their value to this, meaning that this train engine has been impaired. So if you look at the difference between these two, it's 750. In order to get their new individual fair value, you will need to allocate that 750 to each of these using that order you learned. So, and this is how it is done. So in order to determine the carrying amount as of February, I itemized the values given in the question, right? Then the impairment loss of 750, which is the carrying amount minus the value in use, the difference between these two. Then I share the impairment loss among these assets. And I allocate the impairment loss first to a physically damaged asset. I was told in the question that the train engine was one of them, not the two. One of the train engine was completely destroyed. So, and since this 750 represents the value of two train engines, and only one was destroyed, I will need to allocate just half of it, half, which is 375, to the train engine. Secondly, I would allocate to goodwill. I gave goodwill his entire 150 because I have sufficient impairment loss. After taking away 375, I still have enough left. So I gave goodwill. Goodwill becomes 0. Then the third is to other assets on a pro rata basis. And what are the other assets? Operating license, train stations, rail tracks, and don't forget that there is still remaining one train engine that I need to allocate to. And after taking away 375, one train engine that got damaged, and goodwill, the balance of my impairment loss is 225, which is 750 minus 375 minus 150. The balance is 225. Now, I'm supposed to share this balance on a pro rata basis amongst operating license, train station, rail tracks, and one train engine. However, Since this train engine is valued at net realizable value, it means therefore that I cannot impair it further. It means therefore that I cannot allocate further impairment loss to it because that is its net realizable value. That is its recoverable amount. And that is why the remaining one train engine, I didn't allocate it. I didn't impair it any further. Its carrying amount is its net realizable value because that represents its recoverable amount. I cannot impair an asset below its recoverable amount. And that is why this remaining 225, I allocated it amongst the operating license, the train station, and the rail tracks on a pro rata basis. And look at it here. The operating license, I gave it 900 over 1350. And the 1350 is 900 plus 225 plus 225. Okay. That's 900 over 1350 times 225, the balance of the impairment loss. I did that for the train station as well. 225 over 1350 times, and for the rail track. So I got these impairment losses and I put it on this schedule. Okay. Then I got the balance of the carrying amount. And this gives me the carrying amount as of February. The question didn't stop there. He also said I should get the carrying amount as of March. So as of March, I was told that the value of the asset is now 1350. Remember, it was 15 before. So it has suffered further impairment of 150, which I would need also to allocate. So I come here, created a table again. Now my operating license value is now 750 from here, from this last value. My train station is now 187,500, which is this, and this as well. And the remaining one train engine, which is this. So now, having computed this impairment loss, I need to allocate it amongst these assets, these four assets. And using the same order, I need to allocate first to a physically damaged asset. But here we don't have any physically damaged assets. Secondly, I need to allocate to goodwill. Here I don't have any goodwill. And thirdly, I need to then I need to prorate it on a pro rata basis. I need to allocate the balance on a pro rata basis, then which is what I'm supposed to do. However, before I do that, I need to quickly note that this train engine, remember, it is at its net selling prices based from the correction. So I cannot impair it any further still. So that's why I didn't allocate any impairment loss to it. It cannot impair further. That's its selling price. Additionally, we're told that this operating license, somebody came to buy it. They are negotiating it for 675. That therefore means that is the net selling price of that operating license. And that's why I just came to put 675 here. That means automatically I can easily get my impairment loss without any calculation here by just doing this 750 minus 675. So when they give you net selling prices, when you're doing allocation of impairment loss to CG, you need to watch out for all this. You need to watch out for items like this. So now that I've allocated 775 to operating license out of 150, the remaining 75 would then be shared between this train station and rail tracks. And since we share on a pro-rata basis and they are the same value, that means they will be shared equally. So I gave this 37.5, I gave this other guy 37.5. Then when I take away the impairment loss from those values, I will get my carrying amount. I'll get my carrying amount. And the third part of the question says that explain two conditions that must exist before an impairment loss can be reversed. Yes, impairment loss can be reversed, even though it's very, very rare. Like I told you, impairment loss is a permanent loss in the value of an asset. So if there is a positive indicator, there are positive indicators like the useful life increased, the value went up, the productivity improved, that might result in reversal. And also, when you reverse an impairment loss, the new value of that asset must never be higher than its original value before impairment loss. It cannot. That's the principle here. That's one of the conditions. When you reverse an impairment, the new value must not be higher than the original value before impairment. If the original value before the impairment was 100 naira, you now impaired down, you now want to reverse. You cannot reverse it above the original 100 naira. It's either to the limit of that 100 naira or below. You cannot reverse higher than that. So majorly, you'll find all this in this handout. And there's this other one on impairment as well that speaks to, it says, discuss with particular reference to group accounts the two factors which would be important when conducting impairment test under IS 36. Now, again, the two factors are carrying amount and recoverable amount. So all you need to explain when you're explaining carrying amount is just for you to talk about, because they say make particular reference to group account. So when you want to get the carrying amount of a group, it will be the cost minus accumulated depreciation minus accumulated impairment losses of the parent and the subsidiary. So you are probably going to be consolidating the two to get their carrying amount, right? But if you are using a evaluation model to get your carrying amount, it will be fair value minus subsequent accumulated depreciation minus accumulated impairment losses for the parent and the subsidiary. You also need to explain recoverable amount being the higher of net realizable value and value in use. You explain net realizable value, which is the fair value of the asset of the parent and the subsidiary minus cost to sell. You do that also for value in use, which is the present value of future cash flows that can be generated from the continuous use of an asset. So just explain that. The second part of the question says you should discuss how impairment loss in Unit 1 will affect the carrying amount of the net asset of Unit 1 in the consolidated financial statement for 5 marks. And if you look at this question, we're given a company that regularly purchases new subsidiaries. And in June 2019, he bought a subsidiary Bobo. He paid cash of 390. The net asset as at acquisition is 270. That means goodwill is how much? 30 plus 90. That should be 120. Yeah, so that means goodwill is 120 as at the date of acquisition, and no fair value were necessary upon consolidation of Bobo. Oh, okay. So we're not told that as at the year end, the company, the parent, carried out a review of the goodwill on consolidation. Don't forget that the goodwill is 120. So the guy said he wants to review the goodwill for evidence of impairment. And in order to do that, the review involved allocating the net asset of Bobo into 3 CGU. So they allocated the asset of Bobo into 3 CGU so that they can get their value in use. So they give us details of the 3 companies, not 3 companies, the 3 CGUs that they allocated Bobo's assets into. So patents, PP, and all of that. We're also told that it's not possible to allocate the goodwill on consolidation to individual CGU, of course, because goodwill will relate to the entire company. So there's no way you can say, okay, it relates to CGU 1, CGU 2. No, it relates to the whole company. But all other net assets of Bobo are located in the table above. They said the patents, which is this, have no ascertainable market value, but all the current assets have a market value that is above carrying amount. You see, this statement here already shows me how I'm going to determine my impairment loss. They said the patent has no ascertainable market value. That means this 7.5 has been fully impaired. This 7.5 is fully impaired. Is an impaired, as is impaired for it to have no ascertainable market value. That means the recoverable value amount is 0. Also, they said all the current assets have a market value that is above carrying amount. That is telling you that these net current assets you are seeing here, don't bother impairing them, because their market value is above their carrying amount. They are not impaired. That is what the question is telling. They are not impaired. They are not. So don't stress yourself. I was also given the value in use of Bobo as a single CGU is this. So basically, they want us to discuss how impairment loss in CGU 1. So they said, focus on CGU 1. How will it affect the net asset of how will it affect the net asset of unit 1, just unit 1 in the consolidated account? So you will see that in unit 1, I was given the total carrying amount as 127.5. I was given the value in use as 108. What's the difference between the two? Can anyone tell me? What's the difference between the two? 127.5 minus 108.
19.5.
That's 19.5. Now, that's impairment loss of CGU 1. Now, this impairment loss of CGU 1, how do we allocate it? Can anyone also tell me? How do you think we can allocate this impairment loss in CGU 1?
Yes, sir. Since the patent has been fully impaired because it does not have any current market value, so we allocate the patent. And
Thank you very much. I'm with you.
so next would have been what's it called? The net asset, but they said the current asset has a value that's above market value. So we will not impair the current assets. So the balance will be applied to the PPE
Thank you
since
very
it is the
much.
only asset.
Thank you very much. That's absolutely correct. That's correct. So that 19.5 first, 7.5 will go to patents. So that means you do a table for this. But the examiner says discuss. And when they say discuss, you have to be very careful. So it's better you explain. The guy is not looking for your calculation. Just the way Yusuf is saying it, that's how you should write it in the exam. They say discuss. So you tell them that the unit one impairment loss is calculated by comparing the value in use of 181 weights, the total net assets, to giving an impairment loss of 19.5. This would be allocated first to the patent because it has no ascertainable market value, and the remaining will be allocated to PPE, and that's because the net current asset is not impaired because its market value is higher than the carrying amount. So the remaining 12 would be allocated to PPE. And the new net asset can be is as expressed below. That's when you now do your table. You do carrying unit one carrying amount, impairment loss, then the new carrying amount. Then you just write all these figures, 7.5, 90, 30. Under impairment loss, you put 7.5 for patent, you put the remaining 12 for PPE, then 0 for net current asset. Then you remove those impairment loss from the carrying amount to get the new carrying amount, like that. The second one, they say calculate and explain. See, don't always joke. Always watch out for this. They said calculate and explain. So just calculate and explain to them the effects of the impairment review on the carrying amount of the goodwill on consolidation of Bobo. So now they want us to do how will the impairment review on the goodwill affect consolidation. So now you need to then look at the entire company and get their impairment loss. So, and the way that works is that you need to add unit one, unit two, unit three. You add them together as one. So the patent is 7.5. The PPE is 90 plus 45 plus 60. The net current asset 30 plus 375 plus 30. You add them together. So whatever value you get, you also put goodwill of 120 also. You add them together. Whatever value you get is the carrying amount. They also gave us the CG, the value in use of this whole company. So you compare that with the carrying amount. That gives you your impairment loss. Now, that impairment loss, you then need to allocate it. First, you already know that unit one, you have already calculated some impairment loss. So first, you would 19.5 will go. You give 7.5 to patents, 12 to PPE first. That one has been established, impaired. If there is anything remaining, you give that to goodwill. If the goodwill can take everything, fine. And I'm sure the goodwill will consume everything. If there is any other one that is remaining, you will still come back and give it to the PP. You cannot allocate the net current assets. You cannot, and that is it. So then you get the balance and you are done. I can remember that I gave you this as assignment long time ago. Nobody did it, right? For those that have taught this before, I actually taught this. None of you did solve this question. And you'll be shocked if you find it in your exam this day. Without, go and look at it. It's very simple. Go and look at it and see if it's something you can attempt. Because in your pilot, I saw impairment there. Impairment loss will come out in your exam. That one is a given. There's nothing you can do about it. So please revise it. And another notable standard that we did is income tax. Okay, I can see somebody wrote something. Can you say what you wrote? I can't see it very well. What did you write? Why don't you go and attempt it and send and share with me? If you can attempt it tonight, just see. I mean, I actually explained it, and Sarah is saying, "Oh, my J." Okay, oh, okay, oh. Anyway, the good thing about the exam is that it's not answer all. It's just answer 5 out of 7. So you always have choices. You always have choices. Okay. So just for some people that are saying we should go over it again. So is there anyone that can help us? Can you help us, Jacob? Think you understood it.
Yeah. Where should I start from? Sorry.
Start from the A, the unit 1, how we impaired it. Then the entire company, how we impaired it.
Okay. So for unit one, since non-current assets has a carrying a market value that is more than its carrying amount, so it means the non-current asset is not impaired. So we'll get the difference between the total net asset for unit one, that is 127, and the value you use, that is our impairment for unit one. So the way we allocate it is, since the patent has no market value, it means it has been totally impaired. So we remove the 7.5 in total. So that is the first asset that we are going to impair. Then the balance is going to the PPE, since it is the only asset that is left in that CGU, that unit one. So that's how we'll do for unit one. So for the total assets, for the total group, so we'll add all the units and get like another column that says total. For patents, we add all the patents in units 1 to 3 for PPE, for all of them like that. Then we'll now add the goodwill that we calculated before, that is the headline share minus the acquisition. So we have another line that will say goodwill. Then we then get the total net assets of that group. Then we'll now use the value use of 307.5 that they give us to get the difference between that carrying amount and this value you use. That is our impairment for the group. So the way we allocate is since we know that unit one already has his own impairment. So we are going to impair the way we impair unit one before. We are going to impair patents first. That's 7.5. The amount that were impaired in PPE next. Then the balance will go to that goodwill. So if there's any value that is remaining after we have impaired all the goodwill, then it will go back to the balance on the PPE. That's how we'll do it.
Thank you very much, Jacob. And that's really all. So just take this as a challenge. Just try and put it on paper and see if you can attempt it. Simple. I promise you that. It's actually simple. Write it down. Try it. That's what you should be doing right now. That's what you should be doing right now. Yeah. So another notable standard, which you would commonly find in your exam, is income tax. And for income tax, which is IAS 12, this is the last one I'll touch on today. I would finish today's class by looking at the deferred tax application of share-based payments. So, but I just wanted to revise income tax before I go that route. So remember that when it comes to income taxes, there are majorly two. There's current tax and there's deferred tax. Current tax is tax you pay on your taxable profits. Deferred tax is tax payable or recoverable on temporary difference. So for current tax first, since you pay this on your taxable profits, so that means at the end of every year, you will need to get taxable profit. And you can only get taxable profit after you have prepared your account for the year. So it usually falls into the next year. But ultimately, when you get your taxable profits, you apply the tax rates, then you determine how much taxes you pay. Then when you determine that, you usually incorporate it as income tax. Is a line item that comes after PBT. Then the other leg is current tax payable. You incorporate it through a journal into your TB. It doesn't even go to your TB. Well, you can enter your adjusted audited your audited trial balance, and it goes straight into your audited account. Then, after you have filed your returns, the law of the land allows you 6 months after the year end, then you can then pay. But in the meantime, it shows under liability that you are owing. Now, you see, if the tax you have completed is in respect of 2024 account, then this is how 2024 accounts would be published. You always find this liability there because you don't pay this tax until much later when you are filing your returns. So now in 2025, okay, there are usually adjustments that we then need to make. And one of the adjustments is that let's say, for example, now your liability you estimated for in 2024 was 100K. Then you incorporated this into your books as at 2024. So eventually you filed your returns, you paid. But as soon as you file your returns, FRS would review your returns and they will send you a desk review. So let's leave all those stories. They brought in 120. They say that your liability should be 120. So they are claiming that you have a tax payable of 20. So ultimately, you are agreed. You are agreed. So this underpayment of 20, you need to put it in your books in 20. You know that you have closed your books in 2024. This is happening much later in 2025, like around September, October, like that. So in 2025 account, you will now have to put a liability of 20. And remember, this relates to 2024 account. You now debit what we call an underestimation of current tax. It's showing in your trial balance like that. So, which goes to show that ordinarily, you would not find current tax in trial balance. And if you find a current tax in trial balance, you will know that it relates to underestimation or overestimation for tax. In this case, if it's on the debit, it's an underestimation for tax. So it's there. And this is the only one you find there. Because you see, this other one, this liability, is a desk review. As soon as they are giving you your reports, immediately you should go and pay because they will upload it to Tax Pro Max. And as soon as they upload it, you want to settle immediately. Otherwise, the interest is per day. So usually it's something they settle immediately. So what do you then do with this additional expense? Okay, these debits. So the best you can do is to go and add it to your income tax of 2025. That is what we do to it. You go and add it to income tax of 2025. It could be, this is what is common, this is what is realistic. The other one is where you paid 100 last year, then they came and say, no, it should be 80. That one is not possible. They would rather just ignore. They always come with something higher. They can never, it will never come and result in you, them giving you refund. They will not agree. Practically. So that will have been an overestimation for tax, which will be on the credits. That will have been a deduction in the current year's tax. But I mean, in all of this, I put this together in a question. So we are in 2027, 2017. We had a taxable profit of 60. And last year, in 2016, we had a tax of 15. The tax rate is 30. So they want us to calculate the tax charge in 2017. Now, then we're now told that the tax of 2016 was subsequently agreed to be 17,500 and 12,500. Now, how do we then calculate the tax charge for 2017? Firstly is this. The taxable profit of 2017 is 60,000. 60,000. So meaning that the current tax of 2017 is 18,000, which is 30% of 60, is 18, which you are going to take to P&L and also tax payable for 2017. However, since they are just agreeing, you are just concluding 2026 taxes with the tax authority, and they have now agreed what you should pay. They give us two scenarios. Now, scenario A, they agree that it should be 17.5, fine. So remember, so we need to make adjustment for 2026 current tax. We estimated 15, which we paid. But the taxman says, no, it should be 17.5. So that means we underpaid, underestimation. So this is saying that pay additional. So this is an additional expense for me, which I will pay. I will pay immediately. I will pay this 2.5. But the other leg, which is expense, is P&L. It will be an additional tax in 2017. So I will need to add this 2.7 to this 18. I said 2.7, 2.5 to this 18. So the tax that shows in P&L for 2017 is 20,500, not just this 18, because they are saying I underpaid in 2016. So it comes in as an expense this year. However, don't forget that your liability for 2017 remains 18. On no account should this remain unpaid as at the end of 2017. I mean, it's a whole lot for any company. So it's something that is settled immediately. If you cannot settle immediately, you can write for instrumental payments in real life. But here, for simplicity, let's assume it's settled. So what goes to P&L is 2025, while this goes to liability. Now, scenario B, assuming that it was agreed that 12.5 should be paid, which is not practicable. So in that case now, we have already established this, the same as what we did in scenario 1. So we estimated 12. They said it should be 12.5. So that means we have overpaid. They are ready to give us refund. So this will be a deduction because it's a tax credit. I will remove it from this 18,000. So what goes to my P&L is 15.5, right? but I know that my liability, what I owe, that will still show as liability for the year is still 18,000. It's nothing will shake this one. They will still pay it. So, and that's how taxes work. That's all for current tax, really. So the major work lies with your tax department or your tax consultant to compute your taxable profit on which you apply this 30% on. So otherwise, just know this and you're done. Now, so usually when you have current tax, you present it in P&L. So I need you to cram this. So this is the only exception to where you would not present current tax in P&L. So if the current tax is arising from business combination, where you acquire the subsidiary and there is current tax in the books of that subsidiary, so that one you would majorly it's something you're acquiring. So it's like a net asset acquired, which will be treated as part of net asset acquired, which will ultimately might be cancelled out or consolidated as it were. So you won't treat it in P&L. It will be used in calculating your goodwill. Or if the current tax relates to items that are treated in OCI, if there's a tax on item that you took to other comprehensive income, like tax on revaluation surplus, or you need to consider tax effect on a fair value through OCI, or you had a return on plan assets that you need to consider tax implication of, or any other related item that goes to OCI. The tax on it should go to OCI. You don't take such taxes to POL. You take them to OCI as well. And that is all for current tax. And again, lest I forget, you don't offset current tax assets and current tax liabilities in case you have. You need to present them separately. Is there anybody in this class that know conditions that must exist before you can offset your your taxes, current tax assets against current tax liability? Can anyone try? Anyone? You guys are not reading. Don't
Okay,
know.
sir. Okay. I think, okay. I want to try, sir. I think we must have obtained a written approval, sir. I mean, a written, let me see.
Okay.
Yeah,
So,
I
yeah,
think
go ahead.
it's maybe
Olamide.
if you are you are fulfilling the obligation and you are, I don't know, maybe disposing the asset at the same time. I don't know. I'm not sure how to phrase it particularly, but they have to be in the same transaction.
Okay. 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 So, if you have it in your exam, I mean, you just need to find a way around it because these are kind of questions that you need to you need to do something around. And the same answer applies to offsetting financial asset and financial liability. We also, I think they will have also taught you that. We will have also mentioned that also in IS 32. That's conditions on which you can offset those two in your account. Number one is that if you're expected to settle on a net basis, you have an understanding with the counterparty that this transaction would be settled on a net basis. You have already agreed with them, or you have you are legally permissible to, you have a legal right to offset. You have a legal right to offset. So probably maybe for the cases of tax, you went to tribunal, you won, and they said, okay, go ahead and remove the tax credits and pay the government the net. So when you have legal right to offset, or you have an understanding with them that you are going to settle on a net basis. You have an understanding with them. So just find a way to, questions like that, just write something. Don't say you don't know, right? And yeah, I don't expect you to remember everything you've read, but just try to apply some level of judgment, write something, and the examiner would reward you for that. Okay? So then, okay. So deferred tax, So we said deferred tax is taxes that are payable or recoverable on temporary differences, right? So while current tax is payable or recoverable on taxable profits, so this one is payable or recoverable on temporary difference. So that means the major issue here is for us to establish what temporary differences are. And temporary difference are majorly timing difference between the amount recognized in the books and the amount captured by the tax authority for an item. So usually the amount recognized in the books, we call it carrying amount. The amount captured by the tax authority, we call it tax base. So where there are differences between carrying amount and this tax base of an asset or a liability, that is temporary difference. So where these differences arise, we will usually accrue for tax. So if I want to explain this in a very plain term for you, so items like revaluation surplus now. When you have revaluation surplus, the tax, you will put it in your books, obviously, but the tax authority will not tax it because they will say that it is a fictitious gain. Tax authority does not deal with fictitious gain, so they will not put it in their books. They will tell you that when you actually earn it, when you realize that revaluation surplus, then we will tax it. So they will not tax it yet. So you are putting it in your books now, but they are not. They are not going to consider it for tax purposes. So you see, the effect of that is that it therefore means that the tax you are going to put in your P&L and OCI will not include the effects of that transaction, because the taxman is ultimately the figure for tax is ultimately the final determination is the tax authority. So when the tax authority says, no, I'm not taxing it, that means that income tax line will not include the taxing part of that transaction. So that means there's something missing. That means your tax is understated. That means your tax is not fully reflecting the tax impact of all your transactions, right? So that is where deferred tax comes in. That's where temporary difference comes in. That, okay, that's a temporary difference. Let's accrue for that tax. Even though the taxman says he's not taxing it now, let's accrue for it. So that's deferred tax, really. We are accruing for that tax. So, and the way we go about that accrual is just for us to establish where there are temporary differences. It's not just revaluation alone, even provisions. If you make provisions, let's say you have some accruals for, let's say, director's fees. If you put director's fees in your P&L, the taxman at initial stage would disallow it, or any other expense for that matter. They will ask you, show evidence that you have paid it. The taxman does not work, mostly does not deal with substance. They deal with cash flow. They will ask for evidence of payments. That's what, because they believe people that can just create invoice and put it in their books and claim expenses to reduce profit. So they work with cash flow. So mostly accruals, they will tell you, no, I'm not going to allow it. So they will tell you that when you pay this, then I will deduct it. But since IFRS allows accrual basis of accounting, so you will put it in your account. But since the taxman is not considering it, but they will consider it, but not now. They say you have not paid it. So that's temporary. That's why they call it temporary. Meaning they're not considering it now, but they will consider it later. Temporary difference. So, I mean, in layman terms, is that, yes, since the taxman is not going to consider the tax effects, that means something is therefore missing in tax, in that income tax line, which we need to make up with an accrual for tax, which is that deferred tax. So as soon as you get that temporary difference, as soon as you determine the amount that the taxman is not considering or will consider later in the future, just apply 30% on that. That gives you your deferred tax, right? In layman terms, all you're doing is you're accruing for tax. So now, so the first task is for you to establish temporary differences. As soon as you're able to establish that, then you're done, really. And you need to distinguish this from permanent difference. So items like donation, when you make donation to unapproved bodies and you put it in your books as an expense, taxman will disallow it permanently because the donation was made to unapproved bodies. They will disallow it, right? Or when you make some entertainments that are not business-like, or a description of your expense that is not related directly to your activity, or probably you pay fees and penalty, they will disallow it permanently. Or when you receive grants, they will not tax it permanently. So those ones are not temporary difference because those ones don't have any tax effects. So we usually not consider that as temporary. So you don't need to accrue for taxes on that. So that's why we'll never talk about temporary difference or calculating deferred tax on that. So again, the first thing is to identify the temporary difference where the taxman says, I'm not going to consider the tax effect now. There's temporary difference in that case. Now, as soon as we identify that temporary difference, we need to then identify that, okay, this temporary difference will it lead to having a deductions in the future or paying tax in the future. And it's so easy to identify if you are not cramming, if you understand what I've mentioned. If it's a scenario of, for example, provisions for director's fees, for example, now, you put director's fees in your book, but you have not paid them. The taxman says, okay, I'm not going to allow this until you pay. That means in the future, you're going to get a deduction. That's a deductible temporary difference. You're going to get a deduction in the future. So any transaction that the taxman is not considering now, but they tell you that, okay, you get a deduction in the future, that's a deductible temporary difference. And the deductible temporary difference will result to a deferred tax asset now. So by the time you apply 30% on that, it gives you deferred tax asset. It is a scenario of where the taxman said, okay, I'm not going to tax this now, but I'm going to tax it later in the future. And a typical example is revaluation surplus. So look, I'm not going to tax this now. I'm going to tax it in the future when you actually earn this money. So taxable temporary difference, you would be taxed in the future like that. And taxable temporary difference, since you'll be taxed in the future, when you apply 30% on that, you get deferred tax liabilities. And for deferred tax assets, it's not just deductible temporary differences that result in deferred tax assets. It could also be carried forward of unused tax losses or carry forward of unused tax credit. So when you have tax losses, the law of the land, the tax law, the extant tax laws requires that you can use it to deduct you can deduct it against your assessable profit in the future. So that means that's a deductible temporary, it's a deductible temporary difference. So you can consider that in determining your deferred tax assets. Also, when you have tax credits, like withholding tax credits or capital allowances that is unused, you can also use that to determine your deferred tax assets. I don't know whether it made sense, but it's supposed to be a revision. Now, let me ask you a question. Share-based payments. How can share-based payments, is there any temporary difference that can arise from share-based payments? Can anyone speak to it? Is there any deferred tax that can arise from share-based payment?
Under share-based payments, there is no tax, there's no deferred tax in cash settled, but under equity settled share-based payments, it's allowed a deduction, so there can be a temporary difference there.
All right, at least you made an attempt, which is very good. Thank you. So, yes, cash settled,
The intrinsic value.
because you know that for cash settled, what goes to P&L, if you remember, for cash settled, we usually measure cash settled based on the fair value of the option at each reporting date, right? At each reporting date. So is more recent. So what you ultimately take to P&L for cash settled is the value of those options at that date. So, and it's more of liability. Cash settled is liability, something you want to pay. So the taxman works with what you have in P&L. They allow it for deduction. So there is no temporary. The taxman allows it for deduction if it's cash settled, because that's what you are owing. You see, for equity settled, if you remember, it's measured at the fair value of the option at the grant date. And that's how you do it for each year. The taxman believes that's fictitious. Which one is fair value of the option at the grant date? It's fictitious. Taxman will not allow that. So those values we usually determine under equity settled that we take to P&L every year. Taxman never allows it. What the taxman will allow is at the vesting dates, the money, the option you give to them ultimately at at the vesting day, what you give to them actually is what the taxman would allow. What you would give to your employee. So depending on the jurisdiction, there are some jurisdictions that will say, okay, it's the exercise price. There are some that will say it's the intrinsic value, which is market price minus exercise price. So the examiner will tell you what the taxman will allow as deduction. So there is a clear temporary difference for equity settled. Because what you have in your books, they will say, no, I'm not going to allow that. What I will allow is what you actually give to your employee. So for that reason, share-based payment, especially equity settled, will always result in a deductible temporary difference. Always. Because the vesting date is always in the future. When you eventually give your employee those options, the taxman is comfortable with that and say, okay, how much is your expense? That's what they want to work with. And on that basis, they will give you a deduction. But don't forget, we had already recognized these items in our books. We have started recognizing it in P&L. We need to consider the tax effects from year one also. So we need to make deferred taxes. So that temporary difference, which is the deduction that the taxman is saying that is not giving me now, but it will give me in the future, that's a temporary difference. I will just apply 30% on that. That gives me my deferred tax asset because it's a deductible temporary difference. And that is all for deferred tax application of share-based payment. Okay, I will end this class with that. So I saw some questions. I gave some examples. I mean, this is it's worth your time looking at these notes that I have here with you. So I gave you some examples here of determining deferred tax. So they gave us a machine, 5,000. For tax purposes, depreciation is 1.5. The carrying amount is 2.5. So the carrying amount of this asset is 2.5. The tax base, which is cost minus the tax depreciation, which is 1.5. That's 3.5. So it means that the taxman is giving me a deduction of 3.5. I am going to put in 2.5 in my books. So that means I'm having an extra deduction of 1,000 from the taxman. So in the future, that gives rise to a deductible temporary difference. When I apply 30% on that, that's a deferred tax asset. Also, there's an interest receivable that has a carrying amount of 1,000. The related interest revenue will be taxed on a cash basis. It therefore means that I have an interest receivable that I put in my books of 1,000. The related interest revenue, the taxman is saying that I am not going to tax this until you actually receive it. So I have an interest receivable. I already put it in my books. But the taxman says that I'm not going to tax it until you receive it. So they are not taxing it now, but they will tax it later. So in my books, I'm having 1,000. The taxman is saying, no, I'm not going to tax this now. So I'm going to tax it in the future. So they are going to tax that 1,000 in the future. So that's a taxable temporary difference because they will tax it in the future. I just need to apply 30% on that to get a deferred tax liability. Also, there's a trade receivable that has a value of 2,000. The related revenue has already been included in taxable profits. So for this one, they have already included it already. So there's no temporary difference because it's included. Also, there's a dividend receivable that has a carrying amount of 5,000. The dividends are not taxable, so it doesn't have any deferred tax effects. So dividends are not taxable, so it doesn't have tax effect, so there's no deferred tax. There's no need to accrue for tax. The same thing as this. There's a loan receivable of 2.5. The payment of the loan has no tax consequence, so no deferred tax effect on that. Again, there is a current liability that includes an accrued expense with a carrying amount of 3,000. The related expense will be deducted for tax purposes on a cash basis. What's the deferred tax? So again, I put accrued expense in my books, 3,000. The taxman says that I'm not going to tax it until you pay it. So I'm not going to allow it as deduction because it's an expense. So I'm not going to allow it as, so the taxman is not considering the tax effect of that expense now. He says, okay, when you actually pay this expense, come and claim the deduction. So the taxman is not going to consider it. So there's a temporary difference of 3,000, which is a deductible temporary difference. Because I'm putting 3,000 in my books, the taxman is saying, no, you haven't paid it now, so I'm not going to allow it for deduction. So there's a deductible temporary difference. Deductible in the sense that it will be deducted for tax purposes on a cash basis. So that's how I know that it will be deductible. So if I apply 30% on that, it gives me 900 and it's a deferred tax asset. There's a current liability that includes interest revenue received in advance, the current amount of 5,000. So interest revenue received in advance, meaning that you have received the money, but you haven't earned the income. They gave you you received it in advance. So you collected cash, but I mean, your money has not really worked, so you have not earned it. So really, you will not put that in your books as an income. If you want to follow IFRS 15, you should not put it you should put it as a liability. But the taxman works on cash basis. So since you have already collected the cash, the taxman will tax it. You say, I should be have collected the money now. Will tax it. It's an income in your hand for him. He will tax it. So as far as this question is concerned, they say, okay, the taxman already taxed it, but you don't have it in your books now. So that means when you eventually put it in your books in the future, you will not tax it again. So it becomes a deductible temporary difference, right? Because you would not suffer tax in the future since you have suffered the tax now. And that's why we are having a deferred tax asset because it's deductible. Also, there's an accrued expense to carry an amount of 10,000. They have already included, okay, this one, they have already captured it, so there's no temporary difference. The taxman also has included it in this case. There's a fine and penalty that are not included. Okay, there's a permanent difference because this is fines and penalty. They are never deductible for tax purposes. So there's no temporary difference, it's a permanent difference. No deferred tax application. A loan payable of 8,000, the repayment of the loan has no tax consequence. So no deferred tax implication because no temporary difference. It has no tax consequence like that. I solved some other questions with you, which you can actually, I actually solved plenty questions for you guys here. And you can also look through these disclosures, what we disclose for income tax, the current tax, adjustment for per period, deferred tax relating to reversal of temporary difference and all of that. So I started solving questions. Let's see if there's anyone to talk about. you can actually check all of these things. Even this one, I've indirectly discussed it. So you need to review this background I've given you, review it with this handout. So let me end this class with this share-based payments question, deferred tax implication of it coming. Deferred tax implication of share-based payments. Okay, just so that I won't take your time, I will just explain it to you. Where is it? Okay. So if you look at this particular one, so they said a company operates in a country where it receives tax deduction equal to intrinsic value of the share option at the exercises. Okay, so this first paragraph is saying that, okay, in this country, the taxman would only allow the intrinsic value of share options. That's what they allow, intrinsic value. That's what they allow as deduction, intrinsic value at the exercise date too. So we're now told that this company grants share options to their employees on 1st of January, and the fair value at the grant date is 4.8. The taxman will not allow this, right? So the intrinsic value in 2005 is 3.8. And at the exercise date, which is 2006, is 4.2. Tax rate is 30%. And the options reverse in 2006. So what's the deferred tax asset? The examiner can, of course, conveniently ask you what's the deferred tax asset. Because when it comes to share-based payments, you are getting a deduction in the future at the exercise date. So it will always result in deferred tax asset. That's why they are saying, okay, what's the deferred tax asset? And again, they asked for 2005 and 2006, which means that in 2005, they already gave us what the taxman will allow, which is the intrinsic value. They said it's 3.8. So as at 2005, the intrinsic value is 3.8. Apply 30% on that. That should give you deferred tax. Okay. But this intrinsic value, remember, is the estimate of what you would is the value of the option at the what you're estimating you will give to the employee at the vesting date. So it's a cumulative sum. So if you want to get the deferred tax on that relates to year one alone, you need to prorate it by 1/2. And that's because the vesting period is 2 years. The grant date is 2005. The vesting date is 2006. That's 2005, 2006. That's 2 years. So that's why this provision is coming here to get 570. And it's this 570 you recognize as deferred tax asset and deferred tax income to P&L, right? Based on this intrinsic value. This intrinsic value is like temporary difference. Again, they also gave us that at the exercise date, 2006, the intrinsic value is now 4.2. It's something they estimate every year. It changes. So as of 2002 now is now 4.2. You apply 30% on that to get the deferred tax. So this is the deferred tax position as at 2006. So what goes to P&L is the incremental, the difference between year one and year two. So 1260 minus 570 gives 690. And that's what goes to P&L as deferred tax income. By the time you debit deferred tax assets, it actually brings it up to this back because this is what was your deferred tax asset as a year one. So it brings it up to this. And that's how deferred tax on share-based payment works. That's how it works. It's not really more than that. Now, another one that they also asked in 2023, they gave you this guy. It gives share options to two of his staffs at different dates, one in 2019, one in 2020, and they told us the options. They gave us the fair value at the grant date, the exercise and the vesting dates. And I can see if the vesting date is 2021 and the grant date is 2019, that's 2021, that's 2 years vesting period. While this one is 3 years vesting period. Now, I was given the share price as at the end of 2021. They say it's 8 naira, 2020, 8.5 per share. I was told that the directors must be working for Morgan Nigerian PLC on the vesting dates in order for the options to vest. So no directors have left the company since the issue of the share options, and none are expected to leave before the vesting date. The options can be exercised on the first day of the month on which they vest. Now, according to IFRS 2, the company has recognized 600,000 to P&L in 2020. This is what they recognize. We can actually calculate it from here, but doesn't. They have already given it to us that, okay, this is what they recognized to P&L as share-based, as employee, as part of their staff costs majorly. And they also gave us the cumulative expense for the 2 years as at 2021, what they have recognized in year 1 and year 2 cumulatively is this. We're now told that tax allowances arise when the options are exercised, and tax allowances are based on the intrinsic value. So this is telling us that what the taxman will actually allow is the intrinsic value. That's what they will allow as deduction, intrinsic. So automatically, what the major, when I say evaluate the deferred tax implication, I just need to get what's the intrinsic value, because that's the temporary difference. I just apply 30% on that, and that gives me my deferred tax. However, there's something we need to do around this expense recognition. I will show you and explain it to you now. So for the actuals for the deferred tax application in 2020 and 2021. Now, in 2020, if you look at it, as of May 2020, this guy has not really even come into the picture because I only granted him option in June 1st. So is this guy alone, Adamu? So I just need to know that, okay, based on what I issued to Adamu, what's the intrinsic value as at 2020? I was not given the intrinsic value directly, but as at 2020, I was given the share price, 8.5. I was given the exercise price, 4 naira. So it's market price minus exercise price that gives intrinsic value, which is 4.5. So if I multiply 4.5 times the options granted, which is 400, that will give me my intrinsic value, which I computed here for you. So if you do 4.5, I just expressed it for you here. Share price minus, yeah. So I shall get my intrinsic value. So if I apply 30% on this intrinsic value, it gives 540. In order to get my deferred tax for 2020, I will need to prorate this by 1/2 because this is cumulative. It's cumulative for the 2 years. This intrinsic value is like saying that, okay, this is the value of the option. As of today, we estimate that if you are patient till the vesting date, this is the value of what you get. Okay, so on the basis of that, I want to get deferred tax because that's what the taxman will allow. But so I need to share this deferred tax between those 2 years. That's why I'm doing 1/2. If it's 3 years, I do 1/3, something like that. So I did 1/2. So I got 270. Now, is this 270 that's my deferred tax asset? you see here that I'm taking only 180 out of this 270. I'm taking only 180 to P&L. I'm taking the remaining 90 to equity. The reason is this, I can't take this entire 270 deferred tax to P&L. If I take it to P&L, I am now over recognizing tax, because the examiner told me that what the guy has recognized in his books is 600. It's 600,000. If the tax impact of this 600, that the taxman is not allowing this. He said, okay, this 600, I'm not allowing it. What I want to reckon with is the intrinsic. So if you are now accruing for tax, if you do 30% of 600, it's just 180. So you should not recognize more than 180 in your P&L as tax impact. Any excess should go to equity. Just take it to equity. That's what IAS 12 says. Take it to equity. You cannot recognize the entire 270. That means you are over accruing for tax. So, and that's really what is showing up here. Because the deductible temporary difference, the temporary difference here is like this 1.8, you divide it by 2, like the one that relates to year one alone, that's like 900. Okay. And what you are putting in your books, what you had actually put in your books is 600. So, I mean, the intrinsic value relating to this year is higher by almost 300. So 30% of that is 90. You take that's what goes to equity. So however you want to think about it really. So what we are saying ultimately is that yes, accrue for tax, but don't over accrue. Though you need to, especially for share-based payment, that there's an amount that is recognized to P&L every year. What we have actually put in our P&L for that year is 600. You cannot accrue more than 30% of that 600, which is this 180. You cannot accrue more than 180. Anything above that, take it to equity. Now, I did the workings here, depending on which one. Okay, I did only one for you. I compared what you put in your P&L with the intrinsic. Then the intrinsic is higher than it by 300. So that excess, take it to equity. Now, in year 2, right? So Adamu now came in because that's in 2021. No Adamu, Chukwueze. Now for Chukwueze, again, just get the intrinsic value. For Adamu, which we did, is the share price is now 8 naira. The share price is now 8 naira. The exercise price remains 4 naira. So the intrinsic value 1.6. For Chukwueze, the share price is 8 naira. The exercise price is 5 naira. Get the difference, you get the intrinsic value, which is what the taxman will allow. So just do 30% of that. So 30% of this will give me 480. Now, this is year 2 for this guy already. So this is where I want to be as far as year 2 is concerned for Adamu. This is year 2. This is the vesting date. But for Shuku, his vesting period is 3 years, and this is just the year 1. So the deferred tax, the 30% we have gotten on that would multiply by 1/3, because the vesting period is still 3 years for this guy. So we get 360. So 360 plus 480, the deferred tax here is 840. Is 840. So this is now the deferred tax position as at 2021. What you recognize in your P&L is the increase between year 1 and year 2. In year 1, it was 270. So cumulative year 2 is 840. So the amount previously recognized was 270. So deferred tax for the year is 570. Now, this 570, yes, that's deferred tax asset. What goes to your P&L for the year? You need to know how much was recognized as expense. Cumulatively, they recognized 2.2 as expense. Anyway, if I want to know the expense recognized for that year exactly, since this is cumulative and they have recognized 600 in year 1, so how much expense was recognized in year 2? That should be around 1.6, yeah, 1.6. So I take 30% of that. That's what that should actually go to P or L. That's this 480. Alternatively, you can look at it as, okay, the cumulative expense is 2.2. The taxman, the intrinsic value is 1.6 as at year 2, because that's the end for Adamu. This other guy, the intrinsic value is 3.6 times 1 over 3. You add the total intrinsic value as at 2021, which is higher than my expense that I've recognized so far by 600. 30% of that should go to POL, right? I'm taking it to equity, 180. But out of this 180, I've already recognized 90 to equity in year 1. So the remaining 90 is what goes to equity for the year. So either way you want to look at it, gives you the same results. So yeah, and this is what goes to. And it is not all questions that will give you this expense recognized and cumulative expense. So in such scenario, you might not be able to do a split of this deferred tax to equity and P&L. You might not be able to. In such cases, just take everything to P&L. So that means the examiner makes your life easier for you. So you can just go through this. If you understand it, fine. If you don't, leave it alone and move to something else like that. So I'm going to stop here for today. So I think in our next meeting, I'm supposed to revise group account with you then so that I can solve that pilot question. I don't know. So probably maybe we just solve those pilot questions. But since I'm not the one that taught all of you guys group accounts, and my approach to group account is quite different from I don't know if all of you have been watching my videos, but I'll be solving questions on pilots from tomorrow. And tomorrow again, I don't know. I want to also speak on IFRS 18. It's not like the examiner is going to ask you questions on IFRS 18. I just want to teach you IS 1 and just tell you what IFRS 18 has actually brought, the changes brought in by IFRS 18. I just need you to be aware of it. Just so that you know. Just show you few things. No, not like they will start asking you, no, the exam is not going to be based on IFRS 18 because IFRS 18 is going to be applicable in 2027, 1st January. So yes, we need to start being aware, but IS 1 is still fully in action. It's still applicable until 2027, but I mean, you just need to be aware of, okay, this is happening like that. Not that I want to start teaching you IFRS 18, no. Just want to tell you, okay, this is what it has introduced. So I'll see how to mix that together in just a very short 30-minute class, just for me to show you a few things around that. Yeah. So if I forget to share you a link tomorrow, I mean, just remind me, just throw me a reminder so that we can start solving those pilot questions together. So we'll just use Friday, Saturday, Sunday, 2 hours, 1.5 hours. We'll just solve few questions. We'll touch out all those questions on pilots together. Then we'll be done. All the best. Bye. See you.